Yes. Good afternoon, everyone. And I, on behalf of EDI, welcome you all to this series of our monthly discussion today. As you know, that current, as for the international trade is going, I think we are passing through very interesting and challenging time. All these times when we used to talk about that cooperation and coordination and international trade is making the world into a small global village. Maybe all these theories, principles are being tested. We are once again, world seems to be tilting towards more localization, more bilateral trades, and all sort of new theories are coming up. During this interesting time, we are going to have a discussion today on the topic of India UK Comprehensive Economic and Trade Agreement recently signed between the two countries. And as we all know that these kind of bilateral free trade agreements help in expanding the market access, rationalization of duties, and boosting the overall trade dynamics as a whole. And today to discuss about this topic and take us through the intricacies of this particular agreement which has recently been signed, we are happy to have with us Mr. Vidyasagar Hariharan, who is head trade product management from Axis Bank. Welcome, Mr. Vidyasagar. Happy to have you here with us today.
Thank you, Ashwini sir. It's a pleasure. Sorry, you will be missing my regular white shirt and the tie today since I'm logging from home. But thanks indeed. I really wanted to do this session. And thank you for the opportunity provided to do this session. So look forward to an interesting discussion. And hopefully we will also be able to clear all the doubts of the participants once we do go through the Q&A session.
Thanks for joining us and for the benefit and just to inform all the participants, I must, sorry for spilling the beans. I must tell that Mr. Vidyasagar has not been keeping good health for the last few days. And since all this particular program was already announced and we had already declared it, he has been kind enough to not reschedule it and spare time and make it for the program today. Maybe that also, to a certain extent, explains why he was saying that not dressed in the white shirt and the tie, because he has been recuperating and sitting at home. So, thank you very much once again, Mr. Vidyasagar, for joining us, and thanks for
Pleasure is
taking the
mine.
pains
Pleasure
to
is mine, Ashwini sir. Let's begin if, with your kind permission.
and to set the ball rolling, like we call it the acronym, the word of acronym, instead of saying comprehensive economic and trade agreement, we call it the India UK CETA.
CETA.
Could you share your perspective on the evolving landscape of global trade? But I was making a passing
Mm,
reference in my opening
mm,
remarks. We
mm,
are discussing protectionism, gradual shift from multilateralism to bilateral arrangement. As I was saying, that from multilateral agreement to multiple bilateral agreements, kind of thing, and questions around the relevance of institutions like WTO and ICC. Are we entering into a new era of trade framework? How do you see this evolving
Sir, is my
recently?
am I audible? First of all, I think there is
Yes,
a
you are
participant.
audible.
Okay.
Some people are giving some comments. I saw on the
Yeah.
chat window that audio is not clear, but I'm able to hear you
Okay.
clearly.
Okay.
Suggest the participants maybe to
Okay.
check their own system because
Okay.
otherwise it's feeling okay.
Okay. So just to set the context that probably this is from 1930s onwards, this is probably the first time the world is going through such a landscape in international trade. So we are bracing through a situation whereby, as you rightly pointed out, while there have been organizations like GATT, which became WTO, and then we have various chambers of commerce, including ICC, which have facilitated several rules on international trade, and also currently with the picking up of digital trade, for which the UK also has passed a Digital Trade Act last year. The more and more reliance today, where what I see is this. I was reading an interesting article which was published by DP World through their economists some days back, what is emerging as a theme is dual supply chains and dual channel supply chains. What does they mean? Dual supply chains is dependency on limited number of vendors, and dual channel where the trade happens through both digital mode as well as the physical mode. So this is something which is becoming the trend now, but still there is quite a bit of activity to be started. In fact, the beauty of this is now non-aligned countries, probably countries which were not signing up free trade agreements, are signing free trade agreements because everybody wants to look at supply chains which are everybody wants to look at supply chains which will not affect the flow of goods or services into the country. That is something when they select a trading partner, that is something which is being looked at very clearly. And we also get to see this very interesting terminology called friendshoring, which basically outsourcing or offshoring the goods and services to friendly countries. And this dependency on friendshoring is likely to increase. And also finding the sweet spot, balancing diversification and localization. For example, even our government has launched the productivity linked incentive scheme PLI, which aims to. So you would have read in the newspaper today, Ola Electric is probably claiming a benefit of roughly about 74 crores for PLI for completely manufacturing goods, and also PLI plus Make in India is something which government is also looking at, and more suppliers. The beauty of international trade is more suppliers, it is more flexibility, but at the same time, there have been instances also certain trades which have seen lesser number of suppliers but are more steady than having more number of suppliers, because once two countries engage or two companies engage in a bilateral trade, let it be goods or service, it is very difficult to replace. So I will come to the impact of this in what today's context is. And also the outlook today, if we look at it, yesterday we would have seen there is a news report which has come. In August, for the first time, India-US trade has seen a little amount of dip. But what is estimated is that the impact of the new tariffs, probably once they have started in August, how the impact is to be seen or how the contracts are to be looked at, this will be seen. While there are several ways of looking at it, one of the things are replacing multiple trading partners and also looking at multiple arrangements to look at. But replacing a trading partner or replacing somebody, so one of the few important factors that WTO is estimating is that WTO is this is actually before the reciprocative tariff of 50% that was done by the US. But WTO before that was expecting a reduction of 0.25% in the overall trade volumes. And also, this is actually since COVID that the world is also going through an amount of certainty, while COVID had its own peril and the production was affected. Now, this is a man-made factor where production of companies and the realignment of supply chains is going to happen to a great extent. So the impact of recent trade policy changes and it is varying across regions. In fact, this is also a data from WTO that North America now will see a reduction of 1.7 percentage points from global merchandise trade growth. And Europe is expected to grow merchandise trade to a significant extent, while Brazil as well as and the Americas as well as Asia is expected to see a muted amount of growth, considering the current tariff-related discussions that are happening. But what an interesting thing that I also read yesterday, GTRI, the research body, this also had come in Economic Times. This is something which I was reading yesterday, was a very interesting context. While overall, when we look at the India-US trade, we are at a surplus, say we are at 86 billion on the merchandise trade and roughly about 28 billion on services trade. What the GTRI also says is that what is not being counted is the invisibles that flow out of the country, because there is a significant diaspora which goes out of India to study in the US. And you would be surprised the amount of dollars that India spends on the diaspora going out and the student studying is an alarming figure of roughly about 20 to 25 billion dollars in a year, which is something it includes that. That will also take into consideration. It is a major impact that is going to be on. Also, what will get affected from the services side, what WTO estimates is with the while the core services like an IT continue to be out of the tariff related guidelines for quite some time, what will get impacted from the services sector is the transportation. So the number of shipments, the number of transportation, there are vessels involved, all these things are going to considerably get affected, and this will also affect the volume of services that India probably takes from the US, or the vessels that. So this also involves significant amount of dollar inflow and outflow. So this is something which is a very interesting factor. All these invisibles which are there, that also are going to shape. And this is the first year since 2017, excluding the post-pandemic round, where merchandise trade growth outpaced output. So because many of the countries also saw the currency depreciation, and this is also something. And so in WTO estimates, the world merchandise trade has increased to 24.43 trillion, indicating an average decline of export and import prices, but the realizations have been significantly good. Commercial services exports have risen by 9% to USD 8.69 trillion, reflecting strong demand. So there is a huge opportunity on the services side.
That was quite exhaustive, I must say. Some of the few points which I found interesting. One, you said there's people moving towards dual supply chain, dual channel supply, something similar what we call in the retail world, the omni-channel
Correct.
marketing, omni-channel
Omni-retail.
business.
Correct.
Everybody is
Correct.
moving
Correct.
more.
Correct.
And about India-US trade, you mentioned it dipped in the last month, but what's more interesting to find out, overall, if I look at the August 25 data, that overall number has gone up. So that also
Yes.
shows maybe a kind of shuffling happening, as you mentioned, in the global bad trade book also. Maybe one segment, one particular geographical zone
Mm.
is declining, the other side it's growing. And another thing I found interesting in your thing when you mentioned that the overall global merchandise trade at 24.43, slight dip, and the commercial services at around 8.6 billion. So we are talking about around
Trillions.
8.6
Trillion.
trillion or
Mm.
23 trillion of a global trade. And within that, even if I say the normal trend by 25 by 2030, if you are expecting it to go to around 35, 36, India is trying to have a share of 2 trillion out of that.
2
It
trillion.
is it is going to be a
Yes.
2 trillion. That's what we are aspiring for. So
Yes.
it's going to be. I think it's a challenging shot which we are set target which we are set for ourselves, but seems to be maybe the infrastructurally in terms of
Yes.
strategically we seem to be moving in that direction. So to come to the specific
Yes,
topic
sir.
for the day, could you walk through the genesis of the India UK CETA Comprehensive Economic and Trade Agreement? And what prompted this initiative and how does it align with the broader strategic goal? As I was saying, strategic goal, we want to achieve the 2 trillion by 2030. And obviously, we would like to not be over dependent on one particular geography or territory. We would like to spread it out also. How does it fit in all those things?
So interestingly, the target that has been set by the government. So the genesis of this CETA was the foundation stone. The initial discussions concluded in May 2025, and the agreement was signed in July 2025 by Mr. Piyush
Just
Goyal.
you here. There's something I want to bring in a little bit of teaser here for the participant. As you said, CETA was signed in July 25. I'd
Mm.
like to just drop a question here for the participant, which you can answer on the chat window. When was the first time India signed a free trade agreement with any country? Which country was it signed and when was it signed? So I'll just leave it here. I'm not answering. Let's see to make it little more when we are talking about currently in 25, when all these era of free trade agreements started.
That's a very interesting question. I know the answer, but I think participants
Of
should be
course, I
helpful.
know you would be knowing it. I am
Hmm.
an answer from a master of the subject. Just trying to make sure
No, no.
that others are also know.
One of the important even before we get into that, one important point I forgot to mention is that while there has been a clamor that the trade will move to other countries or the volumes will move to other countries, it's not so easy to replace a supply chain where it has been built. So it will take a significant amount of time to also, that is where probably measures like a currency depreciating or some of the other factors which we will discuss in the last, how CETAs can be clearly made a success, what kind of support financial institution. We'll talk about it later. The agreement was formally signed in July 2025, and this is CETA, while UAE India signed the CEPA. UAE India, which was signed in 2022, it has already doubled. The figures have already doubled in 2025. So that is the kind of impact when we look at the right partner, the trade increases. And in fact, even under the CEPA, Indian government has set a very ambitious target of 100 billion only non-oil trade between UAE and India. While the volumes may not be the same, considering UAE is a trading partner, a trading country, and UK is more a consumption-oriented country. The important factor is that, and very interesting uh, data that has been published is that while we think that US is the largest services market for India, it is actually UK, which is more than US. So Versavis 28 billion, which is exported to US in the form of services. Last year, UK had 33 billion in the 2025. So there is significant amount of, and the target is to double this in by 2030, which means that 112 billion of trade. Sorry, 112 billion of trade, including services and merchandise, has been envisaged. And also, almost many items, very few items are coming under tariffs. 99% has been opened up by UK for tariffs, free of tariffs by UK. So this will, the reduced duties are expected to boost bilateral trade. So from 56 billion to double it by 2030. So this also grants access to 99% of the exports to UK, as I mentioned, and covering nearly the entire trade value. So today, whatever we are exporting, there are also some interesting facets which I will cover, which are the relevant segments where we should focus more on, or where we should also have trust even within the CETA. But the primary factor is that the agreement also delivers a significant boost to the services sector, which is a key pillar to both countries. And one of the important things that we also discussed the other day is the movement of physical people, which roughly about UK is now going to give 1,800 people every year, allow 1,800 people every year who are specialists like chefs or some of the very specialist individuals which can, who can also travel. This is also a significant amount which will bring in, and also there would be a savings of roughly about 4,800 crores for India with the taxations that would be cut on the remittances that is being made by these individuals from UK to India. So the pact also supports the growth of small, micro, and medium enterprises by reducing tariffs on advanced manufacturing equipment, streamlining regulatory framework, and also cross-border partnerships. So it also introduces a MSME contact point in both countries to streamline cooperation. One of the areas, however, which needs attention and which can put us in the league is that UK, as I mentioned, had passed the Digital Trade Act in 2023. Now, as we are all aware, IBA is also working with banks on the UNCITRAL model, how to implement it. But where it would help from that, I would talk about it later. And the long-term economic impact is both strategic and transformative. It will move beyond tariff elimination, but tariff is not the only factor. But while it is a major factor, which is the support, it also gives you a targeted approach how to deal with certain countries and how to do trade with these. Sorry, how to do trade and how to look at stronger supply chains and also inclusive and resilient growth. CETA is not only a trade agreement, it's a catalyst for enduring prosperity and a blueprint for future collaboration. And I think this comes at a very key and crucial moment when we are going through a tough phase. And probably any changes in the supply chain, this would be the right, and including textiles, all these sectors have been given very good prominence.
Thanks. I think you have put it across very clearly, basically looking to double our existing business volume from 56 billion to 112 billion
112 billion by
in
2030.
112 billion. And you also mentioned about CEPA as what we have done, Comprehensive Economic Partnership Agreement.
Yes,
The way I look at it, I think CEPA was more focused on the goods and investment flow, goods,
right,
merchandise trade, and
right. There is
flows.
little services trade. Mm.
Whereas CETA is more focused on the services. Merchandise is also there, but more focused on the services. And especially, you also mentioned about the professional mobility, the double contribution convention, which is there with the
Yes,
UK. It's going to
yes,
be a big relief on that. And a
yes,
lot of work on the regulatory cooperation also. So overall, I think CETA is little more wider scope, more comprehensive, as you
yes,
mentioned,
sir.
that
Sure.
strategic and transformative. Though we are already seeing some positive results from the CEPA, I think CETA
Correct,
also is going to
correct,
help us
correct.
in the same direction. Which is, we are looking to see some positive and encouraging results in the coming years. So coming to the current trade dynamics, you have already mentioned our current number at 56 billion,
Yes,
which we are looking to. How is it spread out in the merchandise and services? Those services we have already talked about that the services is more pronounced, more focused in especially in with the UK when we are talking about as compared to the UAE. And along with that services, when how is it spread that 56 billion in merchandise and services? What's the split on that?
so there is a significant skewness of this towards services in UK. That with service merchandise trade of 23 billion, services trade with UK is 33 billion. So this is a target to double. And in fact, even in merchandise trade, there are certain specific sectors where India can quickly catch up, where UK's consumption. We will talk about it when we come to the respective sectors. So the target is 23 to 46 and 33 to 66, and that is how the 112 is coming. And also the one of the other important thing is it also covers areas like investment, intellectual property, and government procurement, which also is very clearly defined under this.
And since we are talking about that, you mentioned that skewness towards services and India numbers also, if you look at, I
Yes,
think our services export has been growing at a much faster pace than the merchandise export in the
yes,
last few years,
yes,
and is the margin is the center for the global capability centers. And I think, if I'm not
yes,
mistaken, we are already in top in the world, the kind of growth we have seen. And recent report which has come by CII, but they call, I think, the National Framework to Position India as a global
yeah,
GCC hub, where they are looking
correct,
at
correct.
maybe some policy advocacy changes in the country, etc. Numbers were looking quite impressive. Today morning,
Yes,
I think I read about 600 billion contribution to
600
the
billion.
economy
Yes. Mm.
overall, and maybe 25 million jobs. That's the potential. Are we seeing
Yes.
where I think I'm sure these kind of agreements and other things are going to be quite helpful and contributing in a big way because this is the target market where we are already having positive, maybe the skew in the favor of the services. So in this, how do you think these two things fitting in how CETA is going to be a catalyst for this particular thing, particularly in
Mm.
enabling the global capability centers and the cross-border service delivery with the
Yeah,
UK or maybe the region.
correct. Sir, on very clearly, CETA contains a chapter on services. So it would be interesting if the members also can download the entire CETA and read it through. It is a very nice and very strategically designed document. Also, it tells how very clearly this kind of an agreement has been worded and how this agreement has been worded. Uh, One of the very important factors is that in the services, UK is opening up on temporary movement of natural persons, and next on professional services, which also is clearly coming under the services under the GATS, all the services related exports which come under this. Also, the important aspect in services is that, as you rightly said, setting up of GCCs of the corporates which are based in UK. In India, the advantage is there is no dearth for talent even in tier 2 and tier 3 cities. For example, a city like Coimbatore, where I belong to, has seen a significant increase of GCCs and certain SEZs also, IT SEZs also. So there's a significant opportunity to. So in fact, not exactly connected with UK, even institutions like Bosch have set up their GCC over there. So it's a good opportunity not only for tier one cities like Mumbai, Delhi, or Hyderabad, but also a good opportunity to set up GCCs for tier two and tier three cities. So and also UK has committed 137 subsectors and also in 108 subsectors which are primarily which the 137 subsectors includes IT and ITES, and the 108 sectors includes accounting services, telecom services, financial services, environmental services. So it is very important to note that today under a FREMA framework, we may have to look at frameworks for carbon credits, and because this is also becoming a very important uh, aspect now, while even the carbon credit exports are, there is no framework, but there is a very clear impact that this can lead to. And also ground handling services for airlines. This is a very important area which UK can provide. And already this would be a most favored nation MFN kind of a commitment. In UK has offered MFN commitments in 114 subsectors, which includes privately funded health services, education services, as well as business services. There is a significant opportunity in all these sectors. And also mobility, sorry, UK has established a regime for temporary entry and stay and requirements of various categories of natural persons, which are intra-corporate transferees, contractual service employees, independent professionals, and have not agreed to impose any numerical restrictions on economic activity. So this is a very important development. UK has also provided mobility commitments in 33 subsectors. This would also mean that the natural persons who go, not only the companies earn dollars or pounds in this matter, it's also the individuals who will be able to repatriate pounds from out of their savings, which is a significant. The NRI diaspora, the remittances that NRI diaspora brings in is a highly, they are unsung heroes. But the point is, this also will lead to a very important agreement. So there is a comprehensive market access and digitally delivered services. So that is something which has been put across. But what also would be important is how do we deliver these services digitally? And Indian side commitments have been extended in 108 subsectors, granting UK firms access like accounting, auditing, financial services with FDI capped at 74%. You can't go beyond 74% FDI, and telecom is 100% FDI allowed. Environmental services and auxiliary air transport, which is basically your ground handling or maintenance, all these kind of services. So market services such as in India, access has very clearly come in professional services, business services, and environmental services, which I also talked about. This will clearly bring investments in India, will also bring technology and competitiveness, potential to serve global markets, and also will be a replacement and also would be a shock absorber in case of any such. So we are diversifying. In fact, I will also talk about agriculture when we come out merchandise trade, or when we talk about specifically on merchandise trade on the respective sectors.
Thank you. Thank you. And just before we move forward, I would like to, you have already given a brief, but detailed analysis on the services sector. Quite a few sectors UK has opened to India, and similarly, India has also reciprocated. There is a question, one of our participants is wanting to know which are the key sectors in India is going to be benefited due to the 99% duty-free access under CETA with UK. Would you like to just re, re
Almost all 99% of these sectors, I don't want to elaborate, but 99% of the sectors which are being the trade happening, including merchandise. So that is the amount of impact, and that is the amount of benefit that is going to India is going to get from the
few sectors, if I may add, like textiles, leather, marine
textile,
products,
leather, correct. And
gems and jewelry.
gems and jewelry is the key. We will talk about it, but I will mention that today we will be surprised that while UK is a big consumer of agricultural products, India's share is minuscule. We will be surprised when we talk about agriculture how low we are there and what is the kind of market potential we have. But yes, textile and leather, as well as the sectors where there is a good impetus on merchandise, it's going to be a very important area of growth.
Right. Since we are talking about the small and medium enterprise, would you like to just give a little bit more insight into how does this agreement specifically addresses the interest of India's SME, small, medium enterprise, and agriculture? Maybe we can go a little more in
Yeah.
detail. Are there any specific provisions or facilitating measures that stand out? You have already mentioned that this is a very comprehensive and very lucid document, very well explained all the points. What are the relevant features for SME in agriculture?
Specifically, two sectors I would like to highlight in the MSME. One is iron and steel. So there is a zero tariff, and which could boost MSME exports by improving price competitiveness and enabling scale up. So this is something which has been very clearly covered under the CETA. And on the import side, to scale up the production of, so UK is also one of the good countries where good quality machinery on manufacturing gets imported. There is a duty-free access for MSMEs, especially in the sectors like renewable energy, automotive electronics, and industrial automation. So this will be a key thing, and this will also help us in the Make in India initiative plus exports, because what kind of incentives that can be provided in this input sectors will also significantly boost. And I think this is where the target of additional 23 billion, and specifically agriculture. India exports 36.63 billion US dollar globally, whereas UK itself imports 37 billion. Our share is just 800 million to UK. So this is a significant area of growth where high value agri products. UK is a very high value market for niche agri. So tea, the Englishman in New York. The song itself says, I like tea and you like coffee. If you had somebody heard that Sting's song. So Englishman.
India, in India, we are consuming more English tea than the Englishman.
So the breakfast tea is a very important component. So, and also products like mangoes, grapes, and spices, as well as marine products. I think it would be a significant market if we're able to scale it up to, say, 5 billion or 10 billion. This itself could contribute significantly agri and agri-allied sectors.
So basically, in the MSME, iron and steel, that's what has gone into the zero tariff, and the duty-free access for the machineries and agriculture, of course, you have already mentioned. Our
True.
share is very minuscule, and that's one of
True.
the high value market that can be one of that low hanging fruit, if I may say so, to tap on somehow for whatever reason. India has never been very performance numbers don't look very great now. Hopefully, with this kind of agreement, this specific provisions, things may improve. So, just to moving on, that would you like to give a little bit thought your views on the strategic takeaways and the institutional role?
Mm,
Maybe, but importantly, how can banks and institutions like FEDI, maybe other market
mm,
intermediaries,
mm.
contribute to successful implementation and the long-term positive impact? Any takeaways or any specific do's and don'ts for that, how we can help achieve the potential, whatever we are talking about?
As I said, this agreement has come at a very crucial time while we are going through the cusp of changes within US. Whereas some of the key role that banks and FedEx can play. So one of the areas where we will be able to increase and improve the trade is through digital channels, which UK is already a pioneer in the Digital Trade Act, which was passed in 2024. And I think India also being reasonably favorable to the changes in English law, traditionally most of this. And IBS have already taken this initiative from UNCITRAL, where from FEDI we can also support. Banks, let me come to banks first. One is clearly the uh, improving digital trade and improving access to customers to easy financing. So as we were discussing the other day also, today also, uh, while the trade finance gap is predicted significantly on exports, the reason today the gap is invisible in India because most of the exporters go with either a CC or a OD even today to draw export credit because anyway you would get a forward premium even then, and the amount of documentation that also is there as far as so. But I think the new draft guidelines would address most of the other factors, but export financing also, how do we simplify and how do we factoring is another important. So while some of the banks have already signed up with agencies like FCI, so we also have recently become an associate member. We are in the process of launching the product formally. These are certain areas where banks can play a very important role. In fact, one of the key points I missed out on the import side, I think it's an important aspect. India imports roughly about 600 million of spirits and beverages from the UK. We know that UK is the capital of Scotch and gin. So today the duties under non-CETA is 150%, and it has been reduced to 75%, and the target is to bring down to 40%. This will also significantly, especially the spirits and alcoholic beverages sector. Okay, well, responsibility is the individual who consumes, but this is one of the very important aspects. Also, where from FEDI can very importantly play a role is take up with RBI through banks where we are always look upon you for putting our liaison to RBI, especially on export finance, because export finance is even today DBS, Department of Banking Supervision topic. So it's not a FED topic. So it would be very important that we looking at a good framework or a slightly easier framework on export finance. Also, probably if WTO and other aspects permit, look at also using rupee export credit and also promulgate the use of Indian rupee at an international stage wherever possible. So especially where Indian GCCs offshore their work to their parent. Usually, parent companies don't let the Indian companies cover their positions. So it would be very imperative that unless of the Indian company exposed to currency fluctuation, especially in the GCC sector, a rupee kind of arrangement with some of the leading UK banks under the SRBA mechanism, where the parent can cover their positions because they'll have set rupee outflow, but at the same time, the Indian exporter of services, especially, will have their own protection. So the key takeaways, again, to sum it up. So banks, FedI have a very crucial role to play in administration of this agreement. Also, where it will help is regular connectivity, regular connections with the chambers of commerce of the respective countries, along with the banks, as well as industry bodies like CII or bodies like FICCI or all the ASOCAM. This will also help, and or as well as FIU. This will also help significantly. While RBI is also looking at simplification of many of the aspects, including small value documents, the simplification, and as well as RBI is also looking at giving a self-service access to exporters to know their EDPMS, IDPMS positions and submit documents. These are some of the steps even the regulator is providing, which will help today the customer who is dependent on banks to look at banks more from a channel perspective to flow, as well as be able to regularize there, because anyway EDPMS IDPMS is a big challenge for India as far as the realizations are concerned. But while it is imperative that the agreements are signed, it is also imperative that the repatriation of these proceeds are also brought on time. This is the responsibility of the exporters as well as banks to look at. So this is where some I would mention. And the key takeaways is it's a landmark deal, to sum it up. Agreement eliminates tariffs on 99% of India's exports to the UK, covering nearly 100% of the trade value. And tariffs on marine products, leather, and processed foods, as you rightly said, have been reduced from up to 70% to now zero in some of the sectors. So it is a very important impetus, especially on textiles. Textiles, India has a significant investment, and I have worked in markets like Tirupur, and these are certain markets where the flexibility of the exporters is very good. So they can set up a line, say within a month or 2 or 3 months, because they just need to change. As well as the services commitment covers IT, financial education, healthcare. Healthcare is another important aspect, and high value sectors. Mobility provisions, they simplify entry for business visitors, professionals, and corporate transferring. And 1,800 Indian chefs, yoga instructors, and artists annually under contractual. And the double contribution convention, which you mentioned, will save annually about 4,800 crores by removing the dual social security. And consumers will benefit from wider product choice, lower prices, and strong digital trade protection. But digital trade, again, to emphasize, will be successful the moment we are able to eliminate physical documents on bill of exchange, bill of lading, and all these documents. It's a uphill task, but I think considering what we have done previously, we will be able to achieve this also. And that would significantly reduce the time and lag of both documents as well as money flowing into the country, which will also reduce the working capital cycle for the exporter borrowers. These are some of the key takeaways.
Thanks, thanks a lot. So if I can just take it the kind of takeaways for people like us, basically, as you mentioned, it for the organizations like FedEx, maybe what you can do is to help in putting together a better, more efficient infrastructure ecosystem
Uh,
where we can move quickly toward digitalization by adoption of unique trial and digital making necessary changes in the law. And fortunately, Indian law is predicated on the UK law. If
correct,
UK has adopted that, that becomes to that extent becomes easier for us
correct,
to follow the same path and move in that
correct.
direction. That's one point which I took note of it. And second one you mentioned about maybe revamp of the export finance, where is the need to bring in more awareness, more outreach about the factoring services. Probably a thing is already, discussion is already on. Work is in the pipeline to bring out little more exhaustive,
Hmm.
revamped export finance guidelines, including more insight and better clarity on the factoring with recourse, without recourse factoring, and all those things. Factoring
So
globally, it's very popular product, but in India, it's still yet to take off. It's still not
gift
the
city can also
most
play a
preferred
very
or the
important
first to
role.
go.
Gift city can also play a very
That,
important
that
role.
that's right. So that these are some of the takeaways. Very true. So these are some of the takeaways for industry to look at it, so that we can help people benefit to make use of all this significant drop in that tariff, as you said, for some of the sectors.
Textile, leather, agriculture.
It's come down from as high as 7, right, overall business. And just in the lighter vein, you mentioned about the Scotch and gin. I think there was no, well, if you don't mention, that's something everybody knew, because all the newspaper, the day it was signed, forget about anything else, always highlighting that the gin and Scotch going to become easier,
Hmm.
cheaper. So that probably everybody don't know anything else about the international trade, but everybody, the consumer of that, they knew that these products are going to become cheaper. Though I don't know actually how much it has impacted the price of the market, but yes, that's
So
something
150 to
very great.
75 is the immediate impact.
So right. That's great. That's a big thing, and I think over a period of time, it's going to drop down to 40.
40. Yeah.
That's what they said. 70, 150 to 75 immediate. Then in future, it is commitment that it will come down to 40%. That's a big thing. People who were going for maybe two drinks, they can now afford for the same price have three or
That is
four.
what I gave the disclaimer.
That's the
That's the disclaimer I gave.
that's right. So one
Responsibility.
thing
Hmm.
at your own risk and responsibility. So surprisingly, nobody has commented upon the first free trade agreement signed by India. I was waiting for some of the responses. Would you like to give us some insights into that?
Let me give you a full insight.
If I'm not mistaken,
Yeah.
maybe that was signed with Sri Lanka somewhere in 2000.
Sri
That
Lanka,
was the first
2000.
Sri
So,
Lanka,
yeah.
first trade agreement with Sri Lanka in 2000. Though after that we had a series of trade agreements, and recently there has been a little bit of acceleration in that particular UK. There is another one in the pipeline with the Eurozone,
Eurozone.
the EU.
Australia has already been signed, whereas it is picking up slow. Australia has
Okay,
already been
the way
signed.
you already signed, you right. So this is a good trajectory where we're moving on. So before we finally wind up, I'll just maybe open the forum. If anybody, any of the participants has got any question, either you can type it on the Q&A, or maybe you can raise your hand. We'll invite you to
So we'll
ask your
take a
question. Maybe
limited
we
number
can
of
have
questions.
another, yes, maybe just one or two questions. If there is somebody, you can
Yeah.
just raise your hand. We'll try to accommodate, pick it up. Otherwise, I think you have already covered the all the issues in quite exhaustive all points, basically in terms of the widening the scope, the comparison between CEPA and CETA, and how these individual sectors, what numbers, emphasis on the services and the GCC, and what sectors are being opened up in the services as well. That has been quite an eye opener for me also, getting to know a lot many more new things, for which we are really thankful to you
So
from
even on the
myself
export
as
finance
well as
side,
on behalf.
even on the export finance
Yeah,
side, especially
right.
while the overall framework needs to be looked at and revamped, it is very imperative that we first look at where free trade agreements have been signed and where we are expecting this to grow to a significant extent. So look at a limited amount of simplification or limited amount of on the basis of certain agreements that have been signed. I think it would take some amount of time to look at this, but that would be a good way to boost the bilateral trade also.
Right. Point well taken. I think one need not, when you are looking at overall revamp, one can look at the specific territories, specific agreements, and then try to do things more in alignment with that so that things can move little faster and we can accelerate the entire process. So with this, I'll just stop here and thank you very much despite not being well and having the fever and all things. You could spare time and spend time with us and share your thoughts and expertise, for which I'm really grateful. And thank
The
you very
pleasure
much
is mine.
for your thanks a lot. It
Thank
was a
you, Ashok
pleasure
sir.
to have you here with us today.
Thank you. Thank you. We
Thank
can
you.
still take a couple of questions if somebody has. Otherwise, we can conclude the session.
Now, just if there is anybody who can raise your hand, you have any question, please let us know. There doesn't seem any. I don't see
Mm.
anybody. That's why I thought maybe we don't need to don't want to hold you back, especially
No,
it's already the
I'll
evening.
just look at the old school thought which my teacher used to say. Either I articulated it fully clearly, or probably I did not articulate it. Just in a lighter spirit. But
This was the first time.
but the key factor would be the administration and the monitoring of the CETA. So that is something which is very clearly required and which is
At
being
least
done
I
in
can
the.
say from my side, yes, it was the first one.
Yeah. Thank you, sir. Thank you so much.
Execution for anything is always the most. Thanks a lot, sir. Thank you.
Thank you so much. And,
Okay. Bye
good
bye.
day to you.
Thanks, everybody. Thank you. Good day, sir.